Hi, and welcome back to the Business Career College video series. In this video, we're going to look at a fairly complicated concept. This is part of the lifetime capital gains exemption. You might be best to consider this as essentially part 2 of the series of videos covering the lifetime capital gains exemption. And what we're going to look at specifically in this video is the cumulative net investment loss, or CNIL. It might be the most complicated concept in the CFP and the Certified Financial Planner curriculum. You don't need this at any level other than a financial planning level. In fact, even at the financial planning level, it's a fairly rarely used concept. So what the cumulative net investment loss expresses for us is over the course of an individual's investing lifetime, what is the balance of investment losses as compared to investment gains? So only somebody who has had more investment losses than investment gains would even have a CNIL balance. And the CNIL balance is only something that we care about when you're attempting to use the lifetime capital gains exemption. Other than that, the CNIL balance is irrelevant. It only matters when you're looking to use your lifetime capital gains exemption. So to get started, let's have a look at what might constitute investment losses. Probably the most common that we would have here would be the deduction associated with an interest expense. But another common example would be a capital loss. So those would be your two most common investment losses. An A-bill is technically not an investment loss, but an A-bill does create a loss for this purpose that does get added into your cumulative net investment losses. Investment gains, this would be dividends, interest income, capital gains, and then on both sides, if you have passive rental expenses and passive rental income would get worked into these two items as well. So what's going to happen here? We'll work through a little scenario. Let's say that we have somebody who goes out and personally borrows. So this person personally borrows, and this is sort of an artificial circumstance, but work with me here. So this person personally borrows $1 million to start a business. And now let's say that this person incorporates this business. So they put $1 million of their own capital into this business. Let's say they have then a $1 million ACB. So they've got this big comfortable ACB here. And now, over the next 10 years, what happens here is they are able to deduct the interest now on that $1 million loan. Remember, they have a $1 million loan. Let's assume they never pay it off. And let's say, just for the sake of simplicity, that they're paying 5% interest on that $1 million loan. That's $50,000 of interest expenses per year times 10 years. Remember, we said that that interest expense is going to be an investment loss. So this person would have, they would have $500,000 of investment losses at this point. And then, over that same 10 years, they're able to pay themselves a little bit of dividend, but not as much dividend as they were taking in interest expenses. So let's say that they were paying for each of those 10 years $25,000 of dividends. And they take that over 10 years, so they've got $250,000 of investment gains. And some real simple math here, 500,000 minus 250,000 gives us $250,000 of net investment losses, or we can see that this person has a $250,000 senile balance. So now, let's say that this person has made the decision to sell their business. Okay, keep in mind they have $1 million ACB, and they're selling the business for $2 million. And the business meets all the criteria for the qualifying small business corporation, so they can use their lifetime capital gains exemption. They've never used it before. They have a full $800,000, as of 2014 anyways, a full $800,000 lifetime capital gains exemption available. And they say, well, I know I'm going to have $1 million capital gain to sell the business for $2 million with an ACB of $1 million. They know they're going to have $1 million capital gain. But the problem here is that they have this senile balance outstanding, this $250,000 senile balance. So what they have to do is they have to bring this to zero in order to use their lifetime capital gains exemption. As I discussed earlier, it's the only time that we care about the senile balance. So the way that they're going to bring this thing to zero, they really have two choices here, two ways that this can be brought to zero. One way is that they could, prior to selling the business, pay themselves a $250,000 dividend, or, and of course that would presumably reduce the value of the business by $250,000, and then they would pay tax on that, or they would have to generate or pay tax on a $500,000 capital gain, which would, with a 50% inclusion rate applied, be a $250,000 taxable capital gain. You'll recall this from the videos earlier covering taxable capital gains and capital gains. In either of these cases, they would have $250,000 of investment gains, and that would, in either case, reduce senile to zero. And then they could use the rest of their capital gain. For example, let's say they go with the second option here. They would have paid tax on this first $500,000 of capital gains. Keep in mind they had a $1 million capital gain in total. So now they could use $500,000 of their lifetime capital gains exemption to wipe out their capital gains entirely. Or sorry, to wipe out their remaining $500,000 of capital gains. And then they would still have $300,000 of lifetime capital gains exemption available. So it's not a simple concept. You can see that the actual application of it would be fairly narrow. This could have easily been avoided. For example, along the 10 years here that we talked about earlier, if this person had paid themselves $50,000 of dividends a year, well, they also had $50,000 of interest expense, then they would at this point have $500,000 of investment gains, and they would have a zero senile balance. They would then be able to use the full $800,000 lifetime capital gains exemption to wipe out most of the capital gain that occurs here. So this is a reason why you might want to be cautious when doing investment planning, that too much interest expense could actually put your client in a position where that senile balance comes back to bite you. Like I said, a fairly complicated concept, and if you're having some trouble here, you might want to go back and review the capital gains videos as well as the lifetime capital gains exemption video. I hope this has been helpful. It's something that it can have some real-life applications when you're dealing with business owners, and especially business owners who are prone to use leverage. It's something that you may have to consider. So I hope you enjoy your studies and watch for more videos concerning the lifetime capital gains exemption. Thank you very much.